Alright, welcome back friends. Hope you're having a very good time. So in today's video, I'm going to talk about covariance. Just to recap, in the prior videos, we have talked about standard deviation or variance of the return. So variance of the returns are basically how your returns are deviating from a average or a mean value. So with that understanding, today we are going to talk about covariance, and as the name indicates, it's a variance of two asset returns. It's a covariance. So there'll be an asset one, let's say stocks, and there could be another asset class, let's say bonds, and each will have its own monthly returns, and you would try to find out how the returns of these two asset classes vary with respect to each other. So that is covariance. So what I have done, some preparation. Again, I went to finance.yahoo.com, and from there I have downloaded some information. For example, this is the monthly return for 7 to 10 year treasury security, and then at the same time I have the return for S&P 500 also, and I took last 10 years worth of return. From those monthly values I have calculated the monthly returns, and you can see those information over here. So this is the value for July, and this is the value for the month June, the closing prices. Just to recap, B3 by B4 minus 1. So what was your opening price, or let's say the previous month closing price? 112.79. And what is the close for the month of July? 113.09, and then subtracting 1 to arrive at a percentage return, right? So this is for 7 to 10 year treasury, and the ticker is IEF. Same thing I have done for S&P 500. So this is the monthly return for these two asset classes. I have deleted other values like open, close, adjusted volume, and etc. because I'm not going to use it, to keep it simple. So with that basic information, let's get started. So first thing that we would need is the average return for treasury. So I got my monthly return, and from there you just take an average and you have your average return, right? Similarly, 0.51% was the average return for S&P 500. 0.53% were the average return for 10-year treasury. Now you all know how to calculate the standard deviation of the monthly return, and I have used the built-in formula in Excel. So you can see it over here, stddev.s, and then you have to select the value which is over here, right? So you will be getting your standard deviation. For your sake of understanding, I have done the calculation using the formula as well. So you have your monthly return, you have your average monthly return. So you calculate how the monthly return has deviated from the average return. So you can see the formula C3 minus F3. Let me just see if I can highlight it. All right, so C3 minus F3, and the same formula has been applied all across. So you are getting the deviation of the monthly returns. So once you have the information, you can take an average. If it is a sample, because we are taking only 120 values, we are not taking all the values of 7 to 10 year treasury. Similarly, we are not taking all the values for S&P 500 because it's a sample, it's not the full population. So you have to, while dividing, you have to subtract 1 from your number of observations. So this S actually denotes sample, and if you can use the same formula, for example, let me just show it to you. You can standard deviation, assuming it's a full population. So I'm just going to write POPU and then STD. There are two, you can see two formulas. So let me see if it, I'm just going to take the population and then enter. So I'm getting almost the same value, right? So 1.89%. I just wanted to, not to confuse you, but I just wanted to demonstrate when you have sample values, not the full population, then the mathematically the correct way is to use S as for sample, and when you have the entire population, you have all the values, so you can use P. All right, let me just delete this. So now we have standard deviation, we have the deviation of monthly return. I have done the same thing for S&P 500 also, right? The next thing that you have to do is you have to multiply both the deviations. If you recall, in case of variance for a stock return, we were actually squaring this value, but in this case we are multiplying the two values. It's almost the same concept because you already have two deviations, deviation of asset class 1 and division of asset class 2. So why not multiply these two? So you can see this is G3 times P3, this is G3 and this is P3. So you're doing a multiplication, and same formula is all across, right? So once you have all these values, what you can do, you can sum up all these values. So you can see the formula, it's sum, let me highlight this, it's a summation of this series divided by total number of observations, and you're subtracting 1 from that number of observations because I don't have all the values. I'm just taking these values as a sample value, and I'm trying to infer that the population will have the same covariance, or I'm trying to say that the covariance between 7 to 10 year treasury and S&P 500 is the value that I'm going to arrive at. But I'm using only 120 observations or last 10 years, but as you all know, S&P goes way back than last 10 years. All right, so this is using the formula. I'm getting a value of very small value, 0.00025. To make the life simple, if you understand the concept, you can directly use the built-in function of Excel, which is equal to covariance.s, because again it is a sample, and wherever is your range. So your range is, you have monthly returns of your treasury, and then you have monthly returns for your S&P 500. So this is two returns for which you're trying to find the covariance, and Excel gives you the covariance, which is the same as what we have calculated. So this is a very important concept in finance. But as you see, covariance is like, if you have to tell me that covariance is 0.00025, I don't think it's going to make any sense to anybody, because it's, first of all, it's a very small value, and oh, so what if it is that, right? So it doesn't convey anything. So a better method or better interpretation of covariance is actually correlation, and covariance is related to correlation. And how is it related? You have to take the covariance, which is so if you divide the covariance with the standard deviation of the two asset classes, or with the product of the standard deviation of two asset classes, you get something called correlation, which is very fascinating concept, which is very easy to understand. So in this case, if I calculate correlation using the formula, I'm arriving at 0.3, or it can also be called as negative 30%. It's negative 0.3. It's all in red. So what it means is that if stock goes up by 100%, then bonds will go down by 30%, right? So both are moving in opposite direction. If one goes up 100%, other will go down 30%. So, and if you see the values over here, for just to verify, you got 0.26% positive return for this particular value, but here you're getting negative 0.32, right? Here you got positive 3.09%, and here you got negative 4.2. So you can see both are, if one is positive, one is negative. So why it is good? Because if you are having these two asset classes in your portfolio, for example, let's say you may be lucky and you may be switching in and out of an asset class at the right point of time. But I don't think anybody is that lucky, and nobody will be doing that much of frequent trading. So what is best for us as an investor is to diversify, because, and it is, if the asset classes have negative correlation, they have greatest diversification benefit. So investors actually look for asset classes which are negatively correlated to reduce their portfolio risk, which is the variability of the return. So I'm assuming that now you have a very good understanding of what the covariance is, what is correlation, and how to calculate covariance and correlations, and most importantly, how to apply these concepts in the real life investing. Stay tuned. I'll be making a couple of more videos. Your feedback is always welcome. Thank you.